Hello, all you lovely people out there trying to make the world a better place. Welcome to the Dead Man Walking podcast. I am your host, Repeatedly Dead Fred, author of the soon to be released memoir, The Summer I Died 20 Times, which is actually what happened to me. And that's how I got the nickname Repeatedly Dead Fred. Today, I'm with Byron Innes, who is the managing director of the Jennings Consulting Group, and he is probably as expert in the insurance industry, life and health, that we have. And I'm thrilled to have him on. Byron, thanks for joining us.
Thank you, Fred. Appreciate it.
My pleasure. So, could you give us a quick recap, of what your organization does? Because you've been in the business forever. We met in the early 2000s when I was a newbie at Canada Life, and I had never met anybody like you. I didn't know people like you existed or organizations like yours existed. So, do you want to give us a quick recap of what you do and why I think it's important that we have you on? Because financial planning is so important to everybody, especially in this crazy economy.
Well, thanks for that introduction, Fred. And yeah, just maybe before I go to Jenny, maybe a little bit of background. As you said in your intro, I've been around the business for a long time. This is actually I've just completed my 50th year in the industry
Wow.
on that. So I'm hit a milestone next year as I cross that line. But first 20 years, 28 years of that, Fred, was in industry. So working in the insurance industry, either selling as an agent, running agencies, establishing MGAs, working in head office, running product development areas, things of that nature. So pretty broad depth of experience before in 2000 starting in consulting. So this is my 22nd year in consulting, and our clientele are pretty much in the Canadian space anyway, pretty much the major players, whether that be large or small. We've worked with pretty much all the insurance companies over the years, the last 20 years, and many of the larger distributors, both in the independent space, like MGAs, as well as in wealth management firms that are in more of the wealth business first and insurance second, if you will, on that. But national accounts are a big part of our business as well. So pretty much everything to do with the distribution of individual financial products, whether that be insurance or investment products and so on. As a group, Jennings Consulting is made up of a lot of senior people. Our typical consultant has in excess of 30 years experience in the industry, whether that be at a carrier or whether that be in consulting. Many of us have had 15, 20 years experience consulting on top of our industry experience. And that ranges from experience in life insurance, wealth management, asset management, P&C. People on our team have led organizations as CFOs, COOs, and so on. So very senior group. So we're able to help clients with their problems, whether that be a problem with growth or expenses or new markets or market entry or distribution, wherever that might be. Someone on our team, or many of us on the team in many cases, have done that type of thing. And therefore we can help our clients fairly quickly with solving some of their key issues. So I'll stop
Mm.
there and I'll let you probe me on what I just said.
Well, I think every company, no matter what stage they're in, has problems with distribution and growth and everything.
Yeah.
Because in some ways, the life insurance and health and wealth management are somewhat of a mature market in Canada, just because our population is growing so slowly. So, um, I'm guessing you're not lacking for business, or
Well,
people asking for you.
we could always use more friends, as probably most businesses could on that. But no,
Mhm.
thankfully we're in great shape, and we have a very nice clientele. Many of who I've worked with for 15, 20 years. So it's great to get repeat business from clients, but also get new clients as well. We really appreciate that. So
Mhm. So is there really any new product development going on in the industry? Because I remember when I
yeah,
came on at Canada Life, probably the big ticket was critical illness. That was the new kid on the block,
yeah.
and it's really hard. I mean, that's part of what I was supposed to be doing at Canada Life, is coming up with new marketing or new product ideas. And then I met these things called actuaries.
Hmm.
And
And
I
they
found
help
out
you
it was,
solve your problems.
yeah, there were no impediment whatsoever. So that was a lot of fun. Is there anything new on the horizon, or are we
It,
still in the? the
Yeah,
traditional.
I think, Fred, that if critical illness was in fact the last, I don't call major category of innovation in the life insurance space in Canada. I mean, we've had universal life now for back into the 80s. I mean,
Mhm,
par whole life is just a huge part of sales these days. Goes back to the probably 1800s, for gosh sake, right? I mean, way
mhm,
back to the formation of the life insurance industry. We're seeing actually, I would say, the reverse of that. Rather than new categories coming on the market, we're seeing categories start to disappear. It's basically
mhm.
long-term care is gone in the Canadian marketplace.
Oh, wow.
Very limited offerings now. We're seeing a pullback on individual disability insurance. Really, realistically, in
Mhm,
the non-can place market, we've got really two players now, RBC and Canada, with Manulife exiting recently. So we're seeing actually a pullback and a focus on some of the what I call core life products, as opposed to a broader range of living benefits and life insurance as well.
mhm,
We're seeing annuities almost, like, I won't say disappear, but shrink to be almost an inconsequential part of the marketplace. As
hmm,
interest rates dropped, we are seeing a bit of resurgence of that now. But again, that's not a new product. That's just an old product that
mhm,
was out of favor for a while and now maybe be coming back into favor on that. So not a lot of innovation, maybe a little bit of innovation, Fred, on what I would start to call bundled products. So this is
mhm.
taking something like a commodity-based term product, which is, basically term A versus term B, company A versus company B. It's the same product essentially, T10, T20. And then premiums are relatively the same, so you can really commoditize that. So what can we do to make that different? So we can throw things in there like uh, repatriation benefit. So if you happen to die somewhere else, we'll bring you home. We'll
Mhm,
throw in some type of guaranteed insurability. We'll throw in things like catastrophic loss benefit to try and differentiate the product, but also so bundle some core things in there that are not necessarily high cost, but maybe high
mhm.
value to the consumer. And even though the likelihood of maybe having a claim of some of the things I just mentioned is relatively small, the cost is relatively small, but it adds a nice benefit to the consumer.
Yes, I think especially in the Canadian market where you have so many of the population becoming snowbirds
Hmm.
and passing away in other locales, helping people get everything home and arranged it is hugely valuable. And
Well, it's even interprovincially. I mean, people don't not necessarily understand that you know, I think they you get it intellectually that our health system is federally mandated but provincially executed. And so
Mhm,
there's differences between what I get in Ontario versus Alberta or whatever. And if I'm traveling in Alberta, maybe I may not get the exact same care that I got in Ontario, or maybe if there's a repatriation issue, things of that nature. So I'm not picking on Alberta at all, but or it's any province, right? That people aren't aware that the
mhm,
differences in the medical system apply not just internationally, but extra provincial as well.
mhm. So with COVID, have the companies taken abnormal hits? Like,
Yeah,
are they? Yeah.
yeah. Well, I wouldn't call them abnormal. I think they would. I mean, yeah, probably abnormal is not a bad word. I mean, they weren't damaging per se. All right, so I
Mhm,
wouldn't want to go too far on that. But we saw companies with millions of dollars of excess claims. I think one company
mhm,
reported 30% spike in claims. But when you look at
mhm,
the dollar amount on those spread, they were easily absorbed by the insurance
mhm,
companies, and didn't really have a giant impact on their financial results during the early days of COVID.
mhm,
We're seeing things like expenses and inflation having and really a pullback in the economy having a bigger impact than the claims impact on life. Now, claims impact on long-term disability, different story.
mhm,
I mean, dramatic increase there. Some of it COVID related, but many of it, much of it rather, related to mental health claims. Just a huge portion of claims now are mental health. In some companies, the biggest cause of claims are in fact mental health and long-term disability. Now, those
mhm,
that's not new. That mental health claims are part of the industry forever. It's the frequency and the magnitude of those claims now that's having the impact. A lot of
mhm,
stress related. A lot of people, we see lots of conversations these days about mental health, conversations that we didn't used to have. All right, and now it's much more awareness of mental health, and therefore people are willing to claim on long-term disability, where maybe 20 years ago they might have just toughened it out, if you will, not made the claim because it was maybe a bit of a stigma to mental health back 20 years ago, or even 10 years ago. So
Hmm.
yeah, lots of claim impact things going on, and companies are struggling to help those people, right? And obviously, when their people are still on claim, that's going to have an impact financially. So I think the impact of COVID might have been more on disability than on death,
Hmm.
which is maybe surprising to some people.
Hmm. Do you think that's going to change the way companies underwrite in the future, both on the individual and the group side?
Um, I don't think so in life, Fred. I mean,
Hmm.
there may be some modeling around, black swan events, if you will, these things that come out once in a century, whatever, about can we
Hmm.
withstand that? That could result in some, I think, modest price increases,
Hmm.
not substantial. But I think regulators are going to look at that as well. Did our companies in Canada withstand those financial hits we just talked about, right? And were they able
Hmm.
to reserve it? Were the reserves adequate for those unforeseen and remarkable, maybe once in a lifetime events? Can we
Hmm.
withstand those, right? So that may be an impact. Um, doesn't impact underwriting so much because you can't predict the next COVID in underwriting, right?
Right.
Right? Who's going to get it, who's not? But it might affect pricing, but not, I don't think, dramatically, but somewhat.
Hmm.
Disability. The challenge with disability is the need is really simple. If I can't work because of injury or illness, I need income. How do you restructure that product differently to say, uh, if you're sick or disabled because of injury or but not because of COVID, right? I mean,
Hmm.
how do you do that, right? How can you sort of pre-write exclusions in and put in things like mental health, right? I mean, there may be some underwriting around that, for new hires, for example. But a lot of
Hmm.
the group insurance, as you know, is non-evidence maximums, and
Hmm.
on that. So I'm not sure how that would play out, on the LTD space, but it's a good question, Fred.
Yeah, and there's so much we don't know about the long haul effects of COVID.
No,
They hit people
correct,
so
correct,
differently at different
correct,
points of their life.
correct.
Um, I've had COVID, I think, 4 times. Like one, I really got hammered, and
Zero here. I got lucky.
that's because you're so good looking. The spike proteins wouldn't come near you.
Yeah.
So, um, yeah, there's no way to manage that, and it can come up at you out of the blue, like 2, 3, 4 years. The myocarditis that they're finding in young people, that's it's going to be very interesting to see how the companies deal with this. Um, so you mentioned that the companies are restructuring. We talked a little bit beforehand about how the insurance companies are structuring themselves less with some of the traditional insurance people and more with people out of the industry. How do you think that's going to affect company cultures going forward? Is that going to lead to some new innovation?
I think it's a great question. If there's no question. I think that when you bring executives from a different industry, they're going to come with a little bit different perspective on on how things should be done.
Mm-hmm.
Whether that's functional, transactional, or whether it is culture, Fred. Um, but you know, I'm always of the view that people get hired to do a job at different times. Right? So you
Mm-hmm.
may need a leader who's a growth person. You may need a leader who is M&A focused. You may need a leader who is operationally focused. I mean, there may be different things in that. So organizations bringing in what I'll call outsiders, i.e., not
Mm-hmm.
growing up in the life insurance industry, they're going to bring a different perspective of a different industry. And mostly what we're seeing is hires from the banking industry. And we've seen that
Mm-hmm.
in a number of the major insurance companies. So they're going to bring a bit of banking culture to that. Um, but they're ones and twos. They're not like hiring 1,000 people from a bank at
Mm-hmm.
2-year-old company, Canada Life, whatever. They're hiring like one or two senior people. So that will have an impact. But the banks do some things better than the insurance industry do, and
Mm-hmm.
vice versa, right? We always complain, I guess, in the insurance industry that we're not as automated as other industries, and that's
Hmm.
been true, and that was really true at early COVID days. On that, so how can we learn from the ability to do online transactions? How can we learn from the ability to do, I can look at my account anywhere I want, anywhere in the world, 24/7, and do stuff, which you can't
Hmm.
really do in life insurance, right? On that, so that kind of thing is good, I think. And that will impact, I think, process over time. And process is where I think some of the next battleground is. We talked about the fact that products aren't really being innovated these days. So if the products are relatively the same, how do I differentiate, right, as a
Sure.
company? And one of those things is in fact processing. And we saw in the early days of COVID, those companies that were ready with electronic applications, electronic signatures, had a large uptick in business, and those that weren't ready had a falling off of business. And it took them a
Hmm.
while to recover. So you think about an advisor, my friend, who says, "Oh, my favorite company I can't do business with anymore because they don't have an e-app and they don't have these signatures. I'll go find a
Hmm.
new company." Well, do I come rushing back when they send me a memo 6 months from now saying, "Hey, we got an e-app now"? Maybe not, right? Or
Hmm.
maybe not fully. So that impacted companies, both short term and maybe to some degree long term as well. So process, we found during COVID, when we did a lot of interviews with advisors and MGAs on this, process won the day in early
Hmm.
COVID times. If I could do this with the companies simply, easy, electronically, they got my business on that. So it's
Hmm.
a lesson for the companies. And one thing that's interesting as well on that, Fred, is that if companies did have electronic processes, they tended to be new business oriented. So
Hmm.
the investments have been made in e-apps and automated underwriting and things of that nature.
Hmm.
Almost no money had been spent on in-force service. So there was
Hmm.
no e-change form, if you will, or e-beneficiary form, or product feature change form, whatever. So all the back-end service functions were all very manual or all very paper-based, and
Oh, I
companies got,
remember that.
yeah, and it hadn't changed, right? So advisors got quite frustrated, saying, "Well, I need to make a change, and I can't see my client because I'm locked down. Give me some way to do this." All right.
Hmm.
So it was interesting how companies had to shift some of their priorities. And you heard anecdotally from a number of companies that so things like, we advanced our digital agenda from 2 years to 3 months, right? That's how
Hmm.
fast they reacted. And it really changed, I think, how companies realized they could in fact get things done quickly. All right.
Hmm.
Where a project that was slated to last 18 months was done in 4 months. I mean, it's amazing what you can do when you really put your mind to it. And I think the
Hmm.
industry benefited from that, sort of a silver lining in COVID, if you will, from that digitization of processes.
I think it's interesting how when I was at Canada Life, they were not just Canada Life, but the life and health industry overall were fighting tooth and nail to keep the banks out of the insurance industry, and now they're pilfering their top talent to come back and make use of those. Um, Talking about process and apps and things about that. Um, it used to be, I think, that the large majority of sales were, especially life sales, were still made like at the kitchen table. Is that still the trend that people want that face to face service
Well,
initially?
yeah, I mean, the whole thing around that people are calling hybrid distribution, Fred, is
Mm-hmm.
been a big panel of discussion. We did a lot of research on that last year. We actually ran a webinar on that for a number of people, and uh, what we found is, it's like the old story of a pendulum. When you start over here, everything's face to face, and then throughout COVID went everything digital, right? Because you couldn't see
Mm-hmm.
anybody live. So the question we started asking is, where's that pendulum going to settle again? Is it going to be
Mm-hmm.
all the way back to face, or is it going to stay digital? And the answer is somewhere in the middle. And what we're finding is a split, where things. I'll give you an example. Advisors are saying, now that I got that digital service form, I'm not driving across town for a
Mm-hmm.
2-minute discussion with Fred to get a signature. I'm sending him an e-form, right? So from a service
Mm-hmm.
point of view, it's going to stay very much digital and on that basis. From a relationship point of view, if I'm meeting you for the first time, it's more, people are feeling this. It's better to have that conversation face to face. So you get to know
Mm-hmm.
me. Once you get to know me, then fine, we can do some business digitally, some business on Zoom, some business just send me the form, I'll sign it.
Mm-hmm.
So there's going to be a shift there. So the more service oriented, the more routine things, they're going to stay in a much of a digital, non-face-to-face world. Things that are relationship based will go back to face, and there's a bunch of stuff that we're going to continue to do exactly what we're doing right now. Right? Are going to be There's no need to, a little more than just send you a form to sign, maybe an explanation, but don't need to see you face to face. And what that's done, and advisors really picked up on this, it increased their efficiency dramatically. If you think of an advisor driving across from Scarborough to Mississauga and back to his office, there's 3 hours of the day gone right there, right? On
Yeah,
that.
at least.
So if I can do that, by in something like this, I just picked up 3 hours a day, maybe twice or whatever. So huge productivity opportunity. Not whether people capitalize on that is another story, but the opportunity to improve productivity is dramatic. We're particularly seeing that in what we would call the wholesale ranks of the insurance industry. So the carrier representatives who go out and talk to MGAs and advisors, and they're the ones that were driving around, right? All the time, different territories. They're not driving around as much, right? Now they've gone back to some face-to-face meetings for sure. Okay, but you think about that. I can see 7 people a day on Zoom, maybe 3 people a day on a face-to-face basis. So maybe I don't go all the way back. Maybe I try and do 5, or I don't know what the magic number is, but obviously there's an opportunity for productivity. And then when you get to the actual distributors, they in turn have their own business development people, their own version of wholesale as well. Same thing held true to them. They didn't have to drive across town to meet with Fred. They could have a Zoom call with Fred. So again, productivity increases there.
Yeah.
So I'm not going to go all the way back because of that. Is the answer.
Can we talk a little bit about how well protected Canadians are versus how well they should be? Because I guess back in the day, we had a simple worksheet, and this is back to my days as a planner for London Life. The general rules, you should have 10 times your income in life insurance. I don't know if the same rule stands right now, or we have better forms of needs analysis. I suspect we do. Do you have a rough idea of what Canadians are carrying versus what they should be carrying?
So a number of organizations kind of check on that. LIMRA does and I think I forget the name of the report they do, but every couple of years they do a report on, and they come up with some amazing, great headline like, the $1 billion baby, which is the opportunity to pick up that extra $1 billion of coverage that Canadians need, for example. Okay, so so whether it's 10 times or it's 11 or whatever, part of that's interest rate driven as well, right? Because you're looking at investing that capital for future needs, income wise and whatever. But the regulators are actually helping that out, Fred, and that most regulators now are forcing a needs analysis as part of a life insurance sale. So rather than me going 10 times, I actually have to ask some questions first on that. And so the needs analysis are getting, I wouldn't say better, but they're getting easier to use. There's some shortcuts about, we can get the same answer by asking less questions if we do the math properly. So they're more consumer friendly. Particularly that's important, Fred, where consumers looking to buy online or online with the aid of an advisor, which is very much part of where some of things are going. You're not going to do online, 35 questions if you're a consumer, or 40 questions. Not going to happen, right? But I got to get to the answer quicker, because otherwise they're going to bail. They don't understand why you're asking me these very detailed questions on that. So the needs analysis tools are getting smarter, simpler to use, more attractive, more consumer friendly, and so on. And the fact that some provinces are mandating a needs analysis at before sale is made is helping that. And particularly if you look at provinces like Quebec, where the AMF has said you can't even recommend a product unless there's a needs analysis done in advance. You can't even get to the product. You start there, do with needs analysis. So there's regulation pushing that, and regulation is having and is going to have a bigger impact on how advice is given and how products are distributed in Canada.
Interesting. So what are the main, I guess there's the 3 main products, or I guess 4 main products. There's the whole life or participating, plain term, permanent term and universal. What's dominating the marketplace, or is it kind of spread evenly right now?
Yeah, I kind of think of it, Fred, as a third, a third, a third, not even the fourth
Mm-hmm.
one.
Mm-hmm.
So it's the short-term terms, the 10s and 20s and 30s. So we're seeing a bit of a
Mm-hmm.
shift to longer-term terms, if you will.
Mm-hmm.
T10 used to be by the dominant product. Most companies are saying, let's go with T20, and advisors are being able to explain the advantages of a T20 to a client quite easily,
Mm-hmm.
actually, if in fact the need is that in that duration. Um, uh, the permanent terms like the T100s basically gone on that.
Interesting.
So you've got the rest is universal life and not even whole life, but par whole life. So
Mm-hmm.
market is par whole life, universal life, term insurance. Those will shift year to year. We
Mm-hmm.
saw as interest rates collapsed, we saw universal life sales collapse along with it, with the interest
Mm-hmm.
rates, and par whole life take up. So people could get guaranteed cash values, dividends with good track records, still not guaranteed, but dividends with good
Mm-hmm.
track records. And that was more attractive than a completely, market-based UL or getting 1% or 0% of my fixed income investment option. Now we're seeing already a shift in universal life sales with the increase in interest rates are already seeing
Mm-hmm.
along. This is the I think this is the first year, maybe even first quarter in the last 6 or 7 that universal life sales increased uh, to any degree at all.
Mm-hmm. So I grew up in a London Life household. My dad was a London Life rep for 35 years. All his buddies worked out of the, everything. So it was London Life, whole life. That
Yep.
was that was the world.
Yep.
And until I came to Canada Life later on, I really didn't even know about universal life products and how they worked. And these things are complicated animals. Um,
They are. They are.
you know, um, how does a consumer figure out which product might be the best? I mean, it's a tough question. Like the best for them, not the best product.
Yeah, I think the answer is they don't. I think they need advice on that. And then the consumer left to
Mm-hmm.
their own, who, to your point, don't understand the differences, and it's very difficult, to do so. They'll gravitate to what's the simplest and what's the cheapest. So if I can get,
Mm-hmm.
$1 million of term insurance for $49 a month,
Mm-hmm.
that sounds a whole lot better than, $500 a month for something that's complicated. I'm just going to grant. So if a consumer left their owner buying term insurance, they're not buying permanent.
Mm-hmm.
And that's not because of just price. It's got to do with the fact I don't understand, right? So, and to me that makes sense, all right? When you get to the sale of universal life or participating whole life, that should be needs based, and that's what the regulators are saying. That's hence the needs analysis conversation we just had. All right, it should be needs based.
Mm-hmm.
Where that need is traditional family coverages, pay off my mortgage, pay off my debts, send my kids to university, and have some income for my family after I die, or it's estate planning for
Mm-hmm.
some type of a large need. And one thing we have seen in recent years is the dramatic increase in the size of par policies being sold. So big
Mm-hmm.
estate planning needs and policies in the tens of millions and sometimes premiums in the millions.
Mm-hmm.
That's relatively recent. I mean, those sales happen from time to time, Fred,
Yeah.
always, but now they're happening regularly, right? The
Mm-hmm.
very, very large sales. So if you look at the number of applications in Canada, it tends to be flatter down most years.
Mm-hmm.
Premiums will fluctuate, but the big increase in par premium sales in recent years has been jumbo cases.
Yeah. I was at a function about 6 weeks ago, and I ran into a person who's fairly wealthy, and he said he had just completed his family trust. And during that process, he found out he had about 10% of the life insurance he actually needed. And it was fascinating to me because here's somebody who, he's a lawyer and a CPA, and he understands money.
Yep.
And he himself was, behind the eight ball on something like this.
I think, back in the mid 90s, I was involved in helping investment advisors get into the life insurance business with the change in regulation in 1995 in Ontario. And I would get comments from investment advisors saying, well, my clients are wealthy. They don't need insurance.
Mhm.
And we came up with the phrase around that time that says, you're probably right. They don't need insurance, but they can use insurance for a better financial outcome.
Mhm.
And that's what's happening to the people you're talking about, that you just talked about, Fred. They're saying, I don't, my family's going to be okay if I die tomorrow. So I don't need
Mhm.
insurance from that perspective. It's not about paying off the mortgage and making sure my kids can eat. It's about, I've got an estate, it's sizable, but I can use life insurance to have even a better financial outcome for my family. Why wouldn't I do that? Right.
Mhm.
And the cash flow to pay the premiums is not an issue because I've got enough assets. So if I can use life insurance effectively as a financial asset, then that makes total sense. And that's where those big sales are coming from. They're not coming from a need, they're coming from a use, right? So
Mhm.
the need versus use is a big part of the equation.
And it simplifies things because it takes a while for estates to be unwound,
Absolutely.
and it doesn't take that long for an insurance company to say, yes, this person is dead. We can free up this cash
Yeah.
flow for
Yeah.
them.
Yeah.
So I think there's a lot of potential for even releasing insurance proceeds before the person dies if they get the proper medical okays from the companies. And I think people don't realize there's that benefit included for many of the companies.
I would say the majority of companies are offering that. If you've got a terminal illness, they will release a portion of the death benefit upfront, up to
Mm-hmm.
some certain maximum. It won't be if you have a $10 million policy, you're not going to release 9 million of it, but
Mm-hmm.
but they release something so that there's ability to access cash. And that's
Mm-hmm.
more important in the you know average consumer market anyways, who don't have
Mm-hmm.
access to cash. But yeah, that's a key feature that's pretty much out there right now, the accelerated death benefit. So
Okay. So can we talk a little bit about pricing? Um,
try.
you if we look at like the cellular service, because we're such a huge geographic area, and our prices are ridiculous compared to most countries in the world. How is our insurance pricing compared to other areas? Are we somewhere in the middle?
Well, it's hard, Fred, to make a direct comparison. I mean, the only part you
Mm-hmm.
can make a direct comparison on is term insurance. But I'll leave
Mm-hmm.
that aside for a second. One of the things we're seeing around the world is that most companies don't have guaranteed products. They have a
Mm-hmm.
product that's priced at the initial premium with the ability of the insurance company to change the rate. Um, so as a result of that, they can set the rates lower today, knowing that if things don't go the right way, they can increase premiums.
Mm-hmm.
So Canada has really very much of a guaranteed premium marketplace. Okay,
Mm-hmm.
so you mentioned permanent term. So the OT 100 is absolutely guaranteed, fixed premium and so on. The term insurance rates are typically have been until recent times fully guaranteed for the renewable period. Well,
Mm-hmm.
T10 renews for another 10 at guaranteed rates and so on. Um, the par products are guaranteed premiums. You don't know what the dividend's going to
Mm-hmm.
do, but you know the premium's guaranteed and the cash values are guaranteed. So, and critical illness, which we talked about a bit earlier, was Canada is one of the few countries that has fully guaranteed premiums on critical illness for the duration of the contract, whether that be to 65, 75, or all the way to 100. So as a result, those guaranteed premiums products tend to be more expensive. All right. So if you could find a direct comparison in, I don't know, Australia, London, England, or Germany, you'd find if it was a direct comparison, you'd find them pretty similar.
Mm-hmm.
Finding that direct comparison today, Fred, other than term insurance, is pretty hard to do. Right.
Mm-hmm.
Um, U.S. has had uh, many decades of non-guaranteed term premiums, so they'll guarantee an initial premium. Like here's your product for 20 years, Fred, and then it switches to annual renewable term on a non-guaranteed basis. That's been
Mm-hmm.
the design of products for a long time in the U.S. That's coming to Canada, has come to Canada in the last couple of years, right?
Mm-hmm.
But it's still not as common as traditional term products.
Okay. So, Byron, we're almost out of time. So, if there is an insurance organization out there that has no idea that you exist, how would they get hold of you and initiate a conversation?
Well, thanks for that, Fred. Very easy. It's at Byren.innes, so BYREN.innes, INNES, at JCL.bm. Very simple email address. And our website is JCL.bm. And you can find us there, no problem at all.
Thank you, Byron, and much appreciated for you coming on with me. I know you're a busy guy,
Thank you.
and but I think this is important that people learn a bit more about the industry, and I think people are generally underinsured, so they need to get in touch with an advisor and
Absolutely do. Yeah, for
get
sure.
caught up.
Well, Fred, it's been
Okay,
great catching up after a lot of years. So thank you for the opportunity to share some information. Hopefully it was helpful to your listeners and great chatting.
my pleasure, and thank you to all the listeners and viewers. Please like, subscribe, share. Look up Byron's company, give him a call, even if you don't have an insurance company. You might find he can consult on some things that are very valuable to help you grow your business. Thank you all. Have a wonderful week and see you next episode. Bye bye.
Bye bye.